Savings rates are significantly higher than they were 2 years ago, but they've been falling for some time now. And with the Bank of England set to keep reducing the base rate in 2025, that could continue. But does that mean that you should opt for a fixed rate savings account to protect yourself from tumbling rates? Potentially, yes. So, what is a fixed rate savings bond? Well, in a nutshell, it's a savings account that guarantees a rate of interest for a set period of time. This is usually between 1 and 5 years, although shorter and longer terms are available. During that time, you can't usually access your money. So, before opening a fixed rate savings bond, you need to be sure you can do without your savings for that time. Now, let's look at the benefits of a fixed rate savings account. So, people opt for fixed rate bonds for lots of reasons, but the main draw is the reassurance of locking in that interest rate. This is especially the case when rates are falling or when the economy is a bit uncertain, which, let's be honest, is most of the time. Fixing your savings gives you certainty and protects you when wider interest rates drop. Sometimes you might find fixed rates accounts pay more than easy access options, though not always. So, right now, you can earn 4.8% if you lock up your money for 12 months compared to the top easy access account, which pays 5.17%. But with the fixed option, you've got the reassurance your rate won't change in the meantime. Now, this can be really attractive to savers, knowing they can put their money to one side and be guaranteed the rate for a set period of time, rather than getting a higher rate now and having it drop within a few months, which can and does happen. For some people, fixed bonds are also appealing because they like the idea of setting money aside that they can't touch. This helps them save towards future goals without the risk of dipping into their money. Fixed rate bonds are also safe, so open one with a provider that's covered by the Financial Services Compensation Scheme, or the FSCS, and up to £85,000 of your savings will be protected if the firm goes bust. So those are the pros, but there are also some cons to fixed rate bonds. For a start, if interest rates go up elsewhere, your money in a fixed rate bond won't benefit as the rate you opted for is locked in, as is your money. So you'll not be able to move it to take advantage of rising rates, you'll have to see out the term. You also won't be able to make withdrawals in the vast majority of fixed rate accounts. One key exception here is a fixed rate ISA, which charges you a penalty fee to take money out early, which is usually the equivalent to a number of days' interest. But otherwise, you can't access money in a fix until it matures. Next, while having limited or no access to your money could be a blessing for some people, it's a disaster for others. Anyone's financial circumstances can change at any time, so make sure you have 3 to 6 months outgoing saved in an easy access fund before even considering locking up your money for an extended period of time. This will put you in a good position to cover any emergency expenses when they crop up. And once you've put your money in a bond, you can't usually make any more deposits. So if you're wanting to regularly save, you'll need to put the money elsewhere. Now, let's talk about tax and fixed rate bonds. If you've got your money fixed for a year or more, you'll need to be mindful of when tax is due on the interest you earn. Basic rate taxpayers get a personal savings allowance, or PSA, of £1,000 a year, which is tax-free. Higher rate taxpayers have a £500 a year allowance, while additional rate taxpayers don't get a PSA at all. Savings interest above your allowance is charged at your usual income tax rate. Any tax applies when you can access your funds, so you could be hit with it at the end of the term of a fixed rate bond. And because several years of tax is being added together and coming for you in one fell swoop, it could push you over your allowance. But let's look at an example. Say you have a 5-year bond paying 4.45% on £10,000. If the interest was added to your balance each year, you'd earn almost £2,490 interest over the 5 years paid at the end of the term. With this example, if you're a basic rate taxpayer, you'd exceed your PSA by £1,490 and be charged 20% tax on that amount. And if you're a higher rate taxpayer, you'd owe 40% tax on £1,990. But there is a way around this. If you opt for a bond where the interest is paid into a separate account each year or paid away, you could avoid tax or pay far less. Using the example I just spoke about, if you opted to pay the interest away, you'd move £445 into a separate account each year. Now, this is within your annual PSA, whether you're a basic or higher rate taxpayer. You will need to check if your provider pays all the interest at the end or if you can pay away, and some might even let you choose. However, there is a downside to paying away, as you'll earn less interest overall than if you kept it in the account. If you keep the interest in the account, you'll benefit from compounding at that fixed rate, which is where your interest is added to your savings, and then you start to earn interest on the interest. But you'll need to work out whether the tax you end up paying is worth it. And of course, if you do pay away, you can also reinvest the interest into a new savings account so it keeps earning interest. It might just be at a lower rate. So, when is the best time to get a fixed rate savings account? Well, you can lock down your savings whenever you like, but it's worth thinking about doing it when you want to secure a rate for a set period of time. Say, for example, right now we're expecting the base rate to fall over the next few years. That will mean that both variable and fixed rate savings will keep dropping. So, even if an easy access pays better than a fix at the moment, it could be that in a year's time, those variable rates will be far lower than locking in right now. But remember, it's never a guarantee that rates will actually fall. You'll also need to compare the return on a fixed rate account versus what you could potentially get elsewhere, say from investing or overpaying on your mortgage. Recently, savings rates around 5% have been very attractive from that perspective, but the lower they get, that might not be the case. And as I mentioned earlier, it's always worth having emergency funds in an accessible account. Fixed rate savings are also quite an attractive option when you have a decent amount of money you want to put aside for a specific goal in the near-ish future, say 1 or 2 years. They're also worth considering if you suddenly come into money. For example, you've received some inheritance which you don't have plans for in the next 12 months or so. For smaller amounts, you may want to consider a regular savings account. So these pay up to 7% at the moment, and the rate is also usually fixed for 12 months. However, you can usually only pay in a couple of £100 a month, which means the interest you earn will be limited. And if you're looking for alternatives to a fixed rate bond, you may want to have a look at fixed rate cash ISAs. The rates might be slightly lower than the equivalent savings bonds, but unlike with bonds, all the interest you earn is tax-free and you can make withdrawals during the term, subject to a penalty fee. For money you won't want to access for at least 5 years, you could look at investing instead. Or you can always contribute to really long-term savings, such as your pension. And that's it. Thanks so much for watching. Check out the videos here for more ways to make the most of your money.